Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone exciting, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in the next week, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market continued its climb into record territory this week, and the market rise puts it in sharp contrast to last December. We saw then the S&P 500 plunge over 400 points on its worst level as the Fed was involved in a double drain. They were doing quantitative tightening, and at the time they were raising rates, and the markets reacted very severely to that as they fell. Also in huge contrast was the Fed attempting normalization back then a year from now, at least normalization as the Fed used to know it. And now we have a new normal, which is QE, seemingly forever, and low interest rates, which they think often about whether or not that makes any sense. And a lot of investors thinking, well, that likely will be forever. So that continues to entice investors into the stock market. With the Fed balance sheet now well over $4 trillion and heading to a record over $4.5 trillion, they're clearly back to responding to a crisis. And desperate to play that down, that nobody should really be afraid of anything and continue pouring money into the stock market. Everything is fine, except for the fact that dealers can no longer digest all of that government debt. And the way the government is now doing it now, this new version of QE, where they're buying only the short term, dealers are kind of hung on the long end, and they're as the Fed soaks up all that short end paper, there's this big imbalance, and that's part of what they're responding to in this big repo crisis that we have going on now, with the Fed pouring hundreds of billions of dollars into that repo market. Eventually, we think there's going to be a spike in the long-term rates that's going to scare investors. Now, we think that the market is good through January, maybe early part of February, but as we get into February and March through May, we think that that spike in interest rates can happen, and that acceleration in interest rates on the long end we're specifically talking about, I think is going to scare the stock market. And that might be what happens, is that maybe the new normal that we're dealing with in the markets is going to be an inflationary attitude that makes long-term rates higher, and that could be scary for the stock market. We saw long-term rates scare the market last year, and what if the Fed actually loses control in the long end of the curve? Well, in the meantime, the yield curve is in its steepest configuration in over a year. We'll talk about that in a moment. It's moved up significantly, and that helps the bank stock. So for the moment, what we're seeing is the steeper yield curve lifting bank stocks. The financial sector is adding fuel to the stock market, which has been moving up just about every single day. That's driving the stock market to very high historical valuations, which we don't think it'll be long that will bring fear into the market when reality really hits home. The past week saw ebullience over the trade deal lift the markets. That started really on Monday, right out of the gate, as the market now seems invulnerable to anything negative. Monday saw stocks climb, and as the European markets and world markets moved up, but then stalled on Tuesday. The Dow was weighed down on Boeing news. They're suspending the 737 MAX productions. That weighed on the Dow, and it weighed on suppliers that make the products, materials that go into the 737 MAX. We now have some airlines extending out the MAX flights all the way out till June. So Boeing's got lots of problems. We continue to talk about the risk in that stock. Wednesday and Thursdays, the market really froze. They just moved sideways, and they were watching the House impeachment process. I'll tell you, partisanship, polarity, it's just a reflection of our diseased government that we're living with, as the Republicans mostly are 100% lined up supporting the president. And the Democrats, outside of a couple of deflections, are lined up completely against the president. So they speak in one voice. They're a bunch of lemmings that just follow their own party. The few people that stood up against their own party, well, I say kudos to them. I don't care what the reasons were. At least they're thinking in their own mind and not following each other. We need to get these people being individual thinkers again. And we're just not going to do that the way we elect people these days. So I'm steaming over the fact that we have a government that just cannot think as individuals, and how we're going to ever get anything done with the polarity that we have in our government right now. Man, they're getting me more deeply steeped in my libertarian views every single day. But even the impeachment of President Trump could not make a dent in the stock market. In fact, Thursday, the markets climbed again as that news came out of his impeachment. And they moved up as the steeper yield curve helped the financials move up again. Friday, we saw more of the same as stock buyers appeared, and yields, the rates seemed to just keep going up. Our outlook remains the same. Despite that the S&P 500 has moved through our upside targets, we were positive again through January. We still don't see a peak until that time or in early February. And now the S&P 500 potential is up to the top of what we call a Fibonacci target zone, up around 3,300 on the S&P 500. So we're not, suggesting shorting the market yet, despite the fact that we think that there's going to be a very large decline in the first half of 2020. But we really think that investors have to get ahead of it. You know what happens? The market falls 5 or 10%, and then investors just don't want to sell. I'm not going to sell now. They already fell, and they're going to go right back up. That's why we think you should be strolling over to the exit door and begin to be selling in this rally that we think is going to continue into January. There's a strong potential, when I say investors must get ahead of it being a big decline in winter and spring of 2020. And I think that will be on an interest rate spike. We're looking for the 10-year, which is now trading up about 1.9%, well, to get up to at least 2.4%, if not higher, during that period. And we think that is going to be enough to scare investors. For this week, stocks continued to move up. They're up around 2%, though the Dow only up about 1% as it's lagging on this Boeing bad news. Bond market 30 years down about 2 points. The 10-year yields moving up 11 basis points. And that 2 to 10-year yield curve, which briefly inverted, is now out to 30 basis points. And man, do the bank stocks love that. Gold market has been just sloshing around here, moving sideways. And silver started to pick up its head today, and that's following a soaring palladium market and platinum market and improving copper market, all of those. And silver up about 20%, we think, is just starting. We think it's going to be a lot more than that, and that's going to be dragging gold to the upside also. We'll talk more about that in the short-term view coming up. The dollar gains about 0.4% on the week. That's a rebound from really getting slapped the previous week. And we're talking about metals firm or rising in a week that the dollar has been rising. That shows you a good relative strength for the metals. And the oil market up about 50 cents on the week. It's the third week in a row, but it's giving ground here on Friday, and we think that is the start of a correction, which we are going to tell you more about as we get further on in this show. So that is the opening. We've got lots of stuff to show you in here as we move to our best and worst stocks for the week. We do this every single week, well, most weeks, unless we have a holiday and shorten up our show. And that is where we look at stocks that had good gains, and we look at stocks that had some pretty serious declines, and we talk about, well, what made that happen, and if there is an opportunity coming up. That's what we always want to look for, are opportunities, trading opportunities. So let's take a look here as we look at the first one. The biggest gainer for the week is ConAgra. This is in the packaged foods area, with Kraft and stocks like that. So what happened in here was the stock had a big gain off of its low right here, and then it started to chop around. And this cycle really looked like it was failing, and it ended up just being a choppy sideways cycle. What is a cycle? A cycle is a rhythmic motion in the market that travels from low to low. The cycles are measured in their lengths, and you can see as we measure from low to low that there was a key low period right here, which was pretty spot on with this cycle. This is called a cycle bracket, and that cycle bracket is simply a guide. It's a drawing tool that helps us find the rhythms, and you could see the rhythm right in here. Is the low is here, the low is here, the low is here, and each of these rally phases gives you a gain. Look at this one right in here. So this earnings beat, their guidance was strong. Analysts all raising targets on this one. And we're raising the targets up to this resistance zone right over here at about $38. This is actually a breakout. So once you get above those key levels, I'm going to show you what those key levels look like in here. I'm just going to grab this tool right in here, and you could see that this was really a resistance zone. And everybody's looking at that zone right over there, and when it breaks out through it, the buyers really show up and break out over here. And this is early enough in this cycle, in the rising phase, to continue on the upside. So if you get a pullback in ConAgra, I would say for aggressive buyers, investors, I think that the stock has greatly improved, and you can see that right in here. So that gives you a little example of what we look at. BBBY is the next stock we're going to look at. It gets another 11% gain. Now, this has the cycle analysis in there, but what we also have added are the phasing. We look at cycles in different phases. If they're rising or correcting, rising or peaking or correcting, or in a very negative phase. When you see a yellow zone, that means that it's in a correction. When you see a red zone, that means that it's in not only a correction, but it has broken down, and that it is likely to continue down through the low time frame right here. You could see that bottom. You see the bottom predicted right over here and the bottom right over here. That says that this Bed Bath & Beyond move may be coming to an end. Now, the reason for the 11% gain is there's a leadership shakeup going on here. The CEO is shaking up the C-suite in order to be more aligned with his plan. Analysts are upgrading it on that, but not huge. Wedbush and Tulsi go up to $18. Well, the stock is $17 now and traded almost up to $18 this week. And Loop Capital, they raise it from 10 to 15. Well, they seem to be behind the curve here. I'm raising it also, and I think it's going to trade up near this 20 area right there, and maybe again. This is the rising support zone here. We might get some correction into that zone, but this is what we call a positively configured cycle being formed, and that says that once it corrects in this area over the next 3 to 5 weeks, it's likely to make a higher high and hit into these resistance zones over there. So we would then be a buyer in that dip over there for higher prices. That is Bed Bath & Beyond, and a good 11% gain on the week. Also gaining 11% is a stock that we turned positive on many weeks ago, and that is Tesla. Interesting, when this Tesla formation really started to get good, I had some emails, and one person even said, "You've joined the cult of being positive on Tesla." Well, I'm never a cult member, and I'm bull bear agnostic. I just read these charts, and when I see formations that we see in here, that says to me that the stock is going higher. The minor cycle hits support and moves up, gets above this level. This configuration where it really took off right over here, that's where you really have to get positive, because there's not much time to correct. This correction only down to the 23% at the perfect nested low, these two smaller cycles lining up for a bottom, that is super positive, and the stock moves up from 326 up to 413. That's 87-point gain in just a couple of weeks, and we think it's going higher. Here's your fib extensions right over here, and you can see we're projecting the minor cycle and the dominant cycle right in here, and for higher prices. Our target now is 420 to 440 on the stock. This big gains that we're getting here is all about China. Their deliveries strong and the registrations really strong in China, and the surprise in here for everybody is that, well, Musk, who talked about this takeover or going private at 420, he's actually getting his price. Pretty amazing when you look at this, and a super powerful pattern that we see here in Tesla. Mosaic is the next one we're going to look at in here. Now, this stock, let me just get rid of all of these drawings that I have in here. This stock is improving. Now, it's not bullish. I can't rate it as bullish. I see momentum improving in here. Excuse me, as we get our little momentum indicator flattening out and turning up. This big upside week that you see here, Mosaic, 11%. Well, they came out with production cuts, and due to market conditions, they say, and weak applications by the farmers, they're pulling back on their production. But look what happens in here. I think this is related to the grain market. The grain market looks great. And if you watch Futures Speak, which we have every single Wednesday when I look at the grains, you'll see why. In this big upside gain. So here's your resistances right up here. We think the stock is just starting. So this is week one on the upside. If you look at the lows right over here, now this is the nested bottom right here, and there are the minor thirds right in here. I don't have the minor thirds marked off, but I can show you 1/3, 2/3, and the third third. When the third one lines up with the bigger one, you get a bigger correction. Here we had a breakdown, which really sent all the cycles down right over here, and then another breakdown, which sent it down to test that low here. Now we're in the first week of this rising phase. The likelihood of it moving up for a couple of months is pretty strong, and we're going to see that it's likely to get up into this 24 area. So I think it's much more about better prices for grains, that applications by farmers will improve, and that's what's going on in here in Mosaic in a fertilizer stock. And you can see in here left-hand translation, we call this, as it peaks on the left side of the cycle, very negative. Another left-hand translation, peaks on the left side of the cycle, very negative. Let's see what happens in here. It is completely undeveloped, and when you're undeveloped, this one over here rose for about 2 months. This one rose for, well, 2 weeks, and then maybe about 6 weeks, and this one rose for about 4 months. So let's see how this configures, and right now it's early enough to say higher prices. And the next one we're going to look at is Netflix, NFLX. Now this stock gets a pop, really moving up, but it is moving up into our sell zones. Now what makes it a sell zone? We have something called swing high, swing low analysis. Here's your swing high, so here's your swing low. Here's your cycles right in here. This took a little longer to bottom, which is typical of a very weak stock. We believe that this selling energy is still in the stock. It's just getting up into the sell zones. The stock moves up based on a strong international growth, but that international growth represents 90% of the growth. In the U.S., the growth just isn't there, and we don't think it's going to be able to maintain that. This is a sell zone in our opinion. So what we're expecting is a decline in here under 303, potentially down to about 293. And we think that there's going to be a short side trade that develops in this area. So the stock moving up on stronger international growth, and we say it is a sell. And that is the best 5 for the week with, I think, some good information. So now let's switch over and look at the worst of the week. We're going to look at some stocks that moved down pretty sharply, and FedEx is the biggest loser of about 11%. Let's switch over from Netflix over to that FedEx chart, and we have had this one as bearish. Now you can see the continued stair-step downward action in here. This has our cycle analysis in there and also compares the UPS pattern to it. So you could see that the lows in here line up with UPS, FedEx being the blue, UPS being the black, how they come and make their bottoms together, and that's because they track each other pretty well. Now, UPS has a little better international exposure, so it's has less exposure to what's going on with Amazon, which is really trying to move away from them and into their both FedEx and UPS and into their own shipping that's less expensive. So we've even had a recent event where the sellers were told not to use ground FedEx shipping because their performance was poor for Amex. So for Amazon. So that really hurt the stock. The stock earnings miss, analysts downgrading it like crazy. And let's look at this. You can see a breakdown right over here and a huge decline right there. A breakdown over here and a stair-step downward move, but that came late. So that gave room for a rally and a breakdown again. Now you can see it's turning down again in here. It hasn't broken down yet, but we think it's going to, and that stock could really be headed, down to $100. This is a very bad looking stock, and I think it's going to continue to get worse. You can see in here the directional components when you look as the stock continues to move to the downside in this big wide downward channel, and we think it's going to continue to move on the downside in there. That is a look at FedEx, the worst stock for the week. Also down 11% on the week is another bad one. Look at the stair-step downward pattern. You can see the green zones and the yellow and the red zones, and it has now moved into a yellow zone with a decline likely out into February. The stock, they cut their dividend, they lowered their guidance, and they just cannot get it going. No matter what the president does about tariffs and foreign imports of steel, they're just not executing at all. There's plenty of steel around the world, and they just guide lower. And you'd think with the world supposedly getting stimulated and palladium having huge gains and base metals looking a little bit better, well, U.S. steel looks absolutely terrible. The steels plainly don't look all that great. So we're looking for lower prices. We expect this stock to be below 10 again by February of this year. Navistar NAV is the next one we're going to look at. Now, we turned positive on this stock. We had it listed as one of the stocks that we thought was going to be really good. And this stock right over here, as you can see, is moving down into this support buy zone. So we expected it to do this and to move down into this zone right around 27 and a half is the middle of it right there. It moves down this week as they guide lower, and and analysts have been cutting their targets. But we think this is a positive formation in here. That is setting up, and technically we believe that the stock will head over this 35-36 area and that it is a buy in this area. So lower guidance, down 7% on the week, but we still think that it is an investable, buyable stock. That is Navistar, NAV. CarMax, KMX, which is retail cars. Of course, when we look at Navistar, that's a car engine business. And look at this. So we have this unusual quad star engulfing. Go ahead, ask me what that is. What is a quad star? Well, there's 1, 2, 3, 4 stars right over there. It's a big advance, and then this big engulfing. So in other words, it opens higher than this bar and then engulfs 5 of these bars right in here. Well, that's clearly a top in CarMax, at least for now when you look at that. But it's getting into this support zone. We're going to look for a drop between 90 and 87 and a half, right in there, and then turning up again. Their earnings missed, but their sales were strong and they had really good comps. I think it just was time for a correction, and we're going to say in the next 2, 3, 4 weeks the stock makes a bottom and then moves up again in there. CarMax, overall, it's been a absolutely great pattern. You can see the last 3 cycles just super strong in there, as it has not been able to have any real significant downside moves. Usually when the momentum turns down, it's in a correction. You can see right in here where momentum turned down and it corrected. This one, the momentum barely could turn down. It was continuing up, and now it's turned down right over here. So we're going to look for 3, 4 weeks of correction in here and then moving up again. And the last one we're going to look at, not much on the downside really, is Lennar, down about 4% on the week. Stock we were bullish on. It hits the fib target zone. You can see that right on there. Let's just move this a little bit out of the way so you can get some sense around that. So that's the fib target zone. It's now correcting, as often does, toward the 34-week moving average right over here. We think this stock is a buy. It's bottoming in the next 1 to 3 weeks right there, and then moving up again. RBC sees tougher times for the home builders in the next year. Of course, I think rates are going to be rising, and that's going to be the case, but not quite yet. Remember, I think the market's probably good for the next 6, 7 weeks, and I think that this is going to bottom and then move up during that period. And I think the same thing for Toll. And you can look for Toll in our trading ideas in the last couple of days. We have that one listed positively, so it's important you go look at it. And I'm going to talk to you about trading ideas in just a moment. That is the 5 worst stocks for the week. And as I showed you that, you get a sense for our style of analysis. We have pretty extensive analysis that we look at, and a very large team and growing team that does all of this analysis and brings all of the content to you. I want to talk to you about that right now because I want to talk to you about our Level 3 membership. This is an incredible membership and getting better and better all of the time. RV and Matt and I mean, we're doing great on this, and I want you to learn about that because we have just changed to our new Level 3, which is now added trade ideas. That's an important thing that we're looking at right in here is the trade ideas. This is different than we used to do before. We were putting out about maybe two trades on average a week that we thought were ideal. Now we're doing it differently as we're exposing you to a much broader list of stocks. And our new trade ideas has 1 to 4 trade ideas every single day. This is great analysis built around our cycle projections, momentum, key support resistances. We look at this, put all that together for the trend, come up with a bias, and we look at the levels that you can enter and expect the targets to go to improve your overall results. Holding periods, there are 3+ weeks in there. So this is for swing trading, option trading, position trading. And you can apply your own analysis. This is really built to support your trading plan. You just take what we give you, listen, look at it, do an evaluation, apply your analysis, and I think you're going to really see that what we bring and why we bring it is really just super valuable to what you look at all the time. This is an example of one of our trade ideas back from November 12th. This was an IWM long. So this is a long on the Russell. It's now inactive because these conditions in the trade idea have been satisfied. That means it came into the favorable entry zone and entered the projected target zone. That we give you all of that. You can see the symbol is IWM, the bias was long, the term that we expected was for 3 to 8 weeks. Sometimes they get fulfilled much faster than that, and this is a trend momentum continuation. So in other words, it had upside momentum. It corrected a little bit, and it gave us our entry, and it moved out. The favorable range was an expectation of a breakout above the 159.95 area. We give you the target zones, and we give you the reevaluation level. In other words, not everything goes right, and if it gets down to a certain level, we have to look at that again, and we might pull it. Likely we'll pull it if it gets to the place where we think it needs to be reevaluated. And we give you the date that we put that on there that you can see. So this was one of the really good trades, and it was satisfied in there as far as entry and hitting our target. This is an example here of one of our trade idea top charts. So not only are we choosing which stocks are the best, but we're letting you vote, and we take the top chart of the week based on your voting, and then we look at it, we evaluate it, and you can see in this case it's still active. On December 9th, Bank of America was chosen. It was a long trade, and this was also a trend continuation. It tested those supports and then began to move up again, and we gave you the favorable entry, the projections, and the reevaluation level, which it never got close to. So that is a look at one of the top charts where you chose which one that we're going to put up as far as an active trade, and that is still active and doing well. Here is a trade idea that didn't work, and of course we have some that don't work. We do our best to give you a very favorable risk-reward ratio and a very favorable successful versus unsuccessful ratio. This is NVIDIA that was a short. It was a counter trend. There were signs that it was stalling, but it didn't. It moved up through the area where we needed to reevaluate it right there, and then it was pulled. So it was pulled in about 1 week, and we said this is no longer a valid trade, and it did fail. So since we've changed to this format about 6 weeks now, we have had 22 trades that have moved into the zone to be successfully entered. And of that, 78% have been favorable. They've hit the entry zones, they've moved up to our targets, and we've moved out. Only 18% have missed. It's incredible how good we do. Of course, we put in all of this analysis where we look at trend and momentum and cycle projections and of the favorable entry and exit levels, and we give that all to you. And we're going to be solidly over 60%. I really believe that, because our analysis is so deep, and that's really what's important. So you also get for level 3 in our membership, and we're talking about our trial here, our Slimulator rankings program. This is incredible. It has our algorithms built into it. It gives you the long-term, intermediate, short-term rankings and our option bias indicator. Take, for example, here, Apple, very bullish. The technical analysis favors the long side. And then you can get our weekly chart and daily chart just by clicking on those. And you can even use this for sorting. You could see what are the best stocks, what are the worst stocks. And it has also ETFs and futures in there. So incredible information that you get in there. You get our trading ideas. You get our Slimulator rankings program in level 3. And you also get everything in level 2, our stock index daily report. That's the SIR report, the SIR index daily report live stream. So we show you our charts live on the S&P 500, the NASDAQ, and the Russell, with supports and resistance and the key acceleration zones where you can really catch the bigger trades. Plus, you get over 400 videos for traders and investors. Man, binge watch those. As you'll have a whole month here in this trial to do so. You're going to learn, what I've learned in 45 years as I do these amazing videos. And of course, you're going to get our Future Speak and Market Week minutes. You can, instead of going through this show or Future Speak and trying to find what I said, we give you the exact spots on the video. You just click on it, you go right to that symbol, and we've also given you notes on each symbol. And you're also going to get everything in level 1, which is the SIR weekly index report, the ETF review, Great things that Matt puts out. And then coming soon, we're working like crazy on this, is our momentum tracker for investors. You're going to be able to see our algorithmic analysis, like I showed you in the Slimulator, on well over 1,000 stocks. And you'll be able to go through all the important watch lists and even build your own watch list. So this is really amazing stuff. All of that, can you imagine everything I just showed you as far as the trade ideas, the Slimulator rankings program, everything in level 2, everything in level 1, just write to Matt for this trial, Matt at askSlim.com. You get all of this 1-month trial for half price, just $48.50. You're not going to get anything like this anywhere. You can get a sense for the type of work that we do. We work like crazy people to bring this all to you. Become a askSlim member. Sign up for level 3, and you're going to learn more than you could ever learn in 1 month. Absolutely fantastic. So please do that. It's just a perfect way to support us and to support your learning. That is Level 3 trial membership. Sign up now. Write Matt at askSlim.com. Write them now. All right, so now let's get into the short-term view for the coming week, where we're going to look at our daily charts. We are doing something a little bit different as we get into the new year and we want to make some changes. Let's move from Linear to the light crude chart in here, and I'm going to switch over to the daily chart so that you can see. So what we have done always in our for 7 years I've been doing this. So when I was in the other network and now at askSlim, I brought you the daily charts, and I brought you what I believe to be what was going to come in the next week. We've had lots of commentary about that, and people want a little better sense for our bias and really looking at what is the overall holding direction that we should be in the shorter term. And that's rather than looking at the little wiggles in the market. So I'm going to discuss a little bit differently this week, and you're going to get a sense for how we're going to be changing this as we move into the next year. It's much more about the focus of the sum of the evidence. I always tell you that I look at support, resistance, at momentum, at cycle projections, and we do that. But I want to bring it really with a little broader focus. Rather than talking about what's going to happen in 1 week, let's just kind of say what's the directional bias and where do I want to be holding for, let's say, the next 1 to 3 weeks. So we're going to look at it a little differently than we did before, and I think you're going to find a lot more value in it. So the accountability I've done is going to also look a bit different. So let's take a look now at light crude, and you'll get a sense for what I'm talking about. So light crude, even though I have been looking for a peak in the intermediate trend, it's really not relevant to what we look at here in the shorter term. You can see consistent upward tracking cycles. So when you have that, you have a directional component that shows you trend. The trend clearly has been up. Here you can see the momentum turned up right over here, and the price moved up from around 58 to about 61. These numbers are a little higher than they were before because we had a roll last week, which affected this. So a positive momentum in here, and what we're looking for continuously here is a likelihood of just minor corrections in what is an uptrend right over here into the support zone. So that gives us a sense that, there's a pretty good possibility we'll get a dip in here. But overall, we're going to say that the bias, the short-term bias, remains to the plus side, which says that you get better upside than you do downside, with the probability of a correction right over here within the uptrend, as you can see right there. Uptrend, positive bias in here, and then another cycle that moves back up, likely to test these levels over here. So as long as we have this positive momentum, we look for that positive bias. Now, what we're looking at here is a projection oscillator that's oversold, which says that these declines may not be that steep. So we're looking for a dip to 59 over here, down to about 58 and a quarter, as the potential correction in what is remaining an upward bias. That is a look at the light crude market for the next few weeks. So now we'll take a look here at the gold market /GC. On the intermediate trend, we believe gold was bottoming. Now, gold has established upward momentum right over here today. It's a weak upward momentum, but there is something else in here, and that is you can see these cycle patterns right over here, where silver bottoms and gold bottoms. That's the blue one is gold. But it couldn't really tick down at all, and that's what we call a cycle swamping. And that says that there's buying coming in under here when it can't make any corrections. So what we're looking at is for the next couple of weeks, this upward momentum to begin to expand and then move to the upside. Our targets on the upside are to move soon over the 1500 level, hitting this weekly resistance that comes from the weekly charts at between 1505 and 1522. That was our similar target that we looked at last week. And the breakout over this area here of about 1491 or so, 1492, which should bring that acceleration up into that zone. So we see a developing upward bias. And even with the dollar having a pretty good upside week, which I'll show you, we had this firm week in gold and up week in the silver market, which really gives you a sense. So we're going to say a developing short-term upward bias that looks like it is becoming positive in the gold market. The next thing we're going to look at is the dollar, which is $DXY. You can see as we look at the dollar in here, it has moved up into our sell zone. Now, we talked about the negative momentum right in here. This is also a negative cycle right in here, as it was moved down pretty strongly and closed much lower than it began, even this bigger cycle right in here. Now we have this potential dominant cycle moving up, and the same thing for this shifted one over here. That should be helping the market move up and has helped the rebound that we're getting in here. But it's moved up into the sell zone right there, and we think that this downward momentum says that we should be in a negative bias. So our bias in here is developed to the downside, and this looks like a rebound. When you have negative momentum and an overbought projection oscillator, you get a sell condition. And you can see the last time we had that was right over here, and when it moved down pretty sharply, it fulfilled that. We think that's where we are right now, that this negative momentum is going to bring it down into the minor support zone. So we're looking for a decline that is within this negative bias, and once this turns over, it could be worse than this, but it's pretty early in this bigger patterns, so maybe it won't be. We're looking for a decline within this downtrend to be more on the minor side and get somewhere below the 97.20 level here, maybe 97.05 here, and then get another rebound again. So for the next few weeks, it would be down and then up, and all of that within the context of some of the evidence that is overall negative. So now we're going to look at the bond market /ZB. You can see that I've changed a little bit on the way we're looking at it, because I really want the focus to be on the sum of the evidence and the potential for the bigger trade, not looking at the market wiggles. We've had people write me, a lot that, I have, a specific bias on the bigger trend, but then when I'm looking for little corrections one way or another, they say, well, you were wrong in that. Well, we don't want to be wrong. We want to really focus on the overall total picture that we're looking at. And when you look at the total picture in the bond market, we have believed on the intermediate term it was negative. Here you could see the momentum turn negative, and when it did that, accelerated down into this potential cycle low bottom area. So what this says to us is that we're likely to continue with this sum of the evidence telling us that the bias should be to the negative side. Right now, it's setting up over the next few weeks for a rebound and then moving down again. So what we're looking at here is a short-term negative bias with a potential rebound into the sell zone over the 57.10 area, 157.10, like right over here, and then setting up another sell into this area here. So that's again, a little extended picture that we're looking at in there. This potential bounce in here means yields will briefly be falling during this period in here of about a week to two. During that period, lines with the dollar being negatively affected by the interest rates structure improving, and that should also help the metals that we talked about. So this potential rebound in the bond market, or potential decline briefly in the interest rate market, and that says to us it's going to open the doorway for the dollar to pull back again, and that should stimulate metals to the upside. So the next thing we're going to look at is the stock market. So we have been looking for little wiggles to the downside and a flattening out, and the flattening out really has not occurred. As a matter of fact, far from that, as we've gotten into these resistance zones and into the extension zones, the market has not really stopped at all. What's really important to note is that these minor cycles, like right in here and right in here, during this very strong upward trend where you see that momentum going up, and that's the slim ribbon. Of course, I've showed you the slim ribbon in all of these today, and if you don't have the slim ribbon on your charts, well, you're missing out in the best momentum tool that I know about. So this is a swamping. In other words, where you get a correction right in here, the momentum is so strong that it can't tick down. It did the same thing right over here. While I'm looking for a little downtick in here, this upward momentum is so powerful that it won't even let that tick down. Extreme strength. That swamping is really positive. So now we're continuing this upward move. When you get far away from that 13-day moving average right there, you often begin to move down towards it. And we still believe that the overall pattern is going to bring you a correction down over here into early January. Now, we talked originally that it was going to be in mid-December, but you could see the swamping of that really prevented any kind of a downtick. We're going to have to see if the energy dissipates enough to get some kind of correction in here out there. So for the next few weeks, what we're looking for is some continued strength in here, and then finding sellers sometime maybe between Christmas and New Year's, and then some legitimate pullback right in here. You can see this pullback right there where they nested. That took you down to 30.70 from a high of about 31.55. So that was a decline of 85 points right there. I would expect you'd get 85 to 100 point decline in this period over here as we've gotten up into this fib extension zone. Note these blue arrows in here that points up to this fib confluence area. That aligns with our the top of the fib extension on the weekly chart up here between 3285 and 3300, 3303. We're looking for this move in January, which should accelerate into that area still. So right now the bigger picture looks for just some modest dip within the context of a very positive bias. Extreme strength brings that swamping. We think that the holiday week, of course, will slow down, and then the risk increases for some modest correction within this strong uptrend that takes you down into January. So no reason to be short this market yet when we look at it, because just because it goes up doesn't mean it'll come down. Well, that is until the rhythms of the market and the money flow show that it's actually doing it, and that's not the case now. The market has continued to be strong, and we have continued to believe that the market would remain that way up until sometime at least into late January, and that is this projection that you see over here taking you up into late January to early February. So this decline, were it to come, would be a buying opportunity in our mind. That's a little bit slightly bigger picture than we normally do it. You can get the sense for how we're going to change this a little bit as we really want to get a focus in on the important aspects of the sum of the evidence in each one of those. That is a look at the 5 major markets. I hope that was great information for you. Please do remember to become an askSlim member. Take advantage of that level 3 membership. Write Matt at askSlim.com. He will send you that important link for just $48.50 for the next month, and you will be able to really explore this extensive work that we do and that our fantastic team is bringing to you. I want you to be so incredibly careful. It is so crazy out there, and we're always wishing you great trading.
Well, I'm going to the city and I'm going to do a steady show.